This is the first of two videos that covers swaps in Chapter 11. Our main interest in this first video is plain vanilla interest rate swaps. There's counterparties, they're exchanging fixed versus floating rates. This should be reminiscent of some material that we covered back in the beginning of the course, where we just covered generically at a very high level options, futures, and swap contracts, and we just motivated them with some examples very early in the course. Now we're getting into the details. We're going to get into the mechanics and the motivation. We're going to look at term structure of interest rates. You can't get very far in any bond or interest rate type sensitive assets without getting into term structure. And the term structure of interest rates is simply the yield associated with various maturities of treasuries, for example, or a swap yield curve, things that'll pop up, concepts that'll pop up later in this video. But term structure is really, really important. So I will cover that again. I will refresh your memory. And the reason why I say I refresh your memory, you've had to have seen this before, term structure of interest rates, in your basic finance course, or an investment management course, or a markets course, and even in economics you'll see this term structure. So even if you have not, and it's pretty hard for you not to have seen it, I'm going to cover it anyway and give you the basics of what term structure is, because we're going to use it when we price swaps. We're going to look at swap spreads. We're going to look at forward rate agreements, which delves a bit into the next chapter, chapter 12. So when we cover this chapter 11, we're jumping in a little bit into material that's in chapter 12. I can't explain why your authors pushed forward rate agreements so far back. To me, they're one of the first things you want to set up early on when you talk about interest-sensitive assets. You want to look at forward rates as soon as possible. And forward rate agreements, they're nothing but forward contracts based on an interest rate. And so you have a forward rate. You need two other things, though. So let's back up a second. When we looked at forward and futures contracts with corn, for example, you had a futures price. And you had a contract size, like 5,000 bushels for a contract. There was really no time element other than when the expiration of the futures contract happened. But with forward rate agreements, it's based on an interest rate, and then you need a notional value, which is basically the size of the contract. What's the face value of the instrument? Because you need to convert interest rates into dollars. People write checks and move money electronically in dollars, not percentages. And so forward rate agreements are based on an interest rate, a notional value, and then there has to be a time dimension, because you can't borrow or lend money for a split second. If there's no time element to it, then there's no interest expense or interest income or gains and losses. So there's got to be a time element to it also. We'll look at Libor, which is the London International Bank Offering Rate, which is a very common floating rate out there, an index to match up for floating rates. And we'll talk about that. We'll look at swap pricing, which is determining the swap's fixed rate, which is denoted as capital R. And then we'll value a swap. Remember, pricing a swap and valuing a swap are two different things. Pricing a swap is determining the swap's fixed rate, R, which is a percent. Valuing a swap means putting a dollar sign on it, a dollar amount on it. Then we'll look at swap quotes. Okay? And then now that's in this video. The next video coming up, video 2, we'll look at flavored swaps. And we'll look at basis swaps, commodity swaps, and equity swaps. We're not going to go too deep into these particular swaps. More or less just the basic intuition and then an example for those. But when we get into credit default swaps, they're one of the sources of the huge problem that came about in the liquidity crisis in 2008 and 2009. Credit default swaps were at the center of that crisis. As usual, we will skip currency swaps. Okay, let's jump right into plain vanilla interest rate swaps with an example. And so here we have a company, ABC company. Right now it has outstanding, so it has bonds that it's paying 5% fixed. So when you see a percent, like 5%, it's fixed. It's not changing. Okay? And so the down arrow basically means, in this case, that money's going out the door to these bondholders. And ABC, though, is looking at this, and the chief financial officer is thinking, we're paying this fixed rate, but I think interest rates are going to fall. Okay? If this person expects interest rates to fall, then they want to get out of this paying this fixed rate, and they want to pay what's called a floating rate, so that when interest rates actually fall, their payments will fall, kind of like a variable rate mortgage. And so plain vanilla interest rate swaps are a mechanism to help ABC out. But in order to have ABC helped out, you need to have a counterparty. So ABC is a counterparty, and there's another counterparty that must have expectations that are opposite of ABC. So ABC expects rates to fall, then there must be another company that expects rates to rise in order for those two parties to meet, to agree to swap interest payments. And so a plain vanilla interest rate swap is all about swapping fixed payments for floating, as we will see. Now let's look at ABC over here. The counterparty, XYZ company. XYZ has floating rate debt of that pays Libor, and the L stands for Libor, plus 1%. So Libor is, when you see an L, a letter like Libor, that means that rate it changes. That's why it's not a particular number like 5%. It means it's going to change. And so they're paying Libor plus a little bit more of a spread because, this company could be fairly risky. And Libor is called the London International Bank Offering Rate. It's a fairly low rate with not too much risk premiums in there. There are risk premiums that we'll talk about a little bit later in there. But this XYZ company could be a little riskier, and so bondholders demanded not just that Libor rate, they also demanded an extra 1% on top of it. Okay? But XYZ company, they expect rates to rise. Okay? They expect rates to rise, and if that's the case, they want to lock in the low fixed rates today. Okay? So XYZ expects rates to rise. ABC here expects rates to fall. How do they get together? Well, that's what brokers and dealers do, and that's what financial intermediation is all about. You find a financial institution that has a network system that looks for various parties with different interests and matches them up so that they can swap out or buy or sell. I mean, it's just like the same thing that a stockbroker does. You got people who expect Apple stock is going to go up, and there's people who expect Apple stock to fall. So the people who expect it going up are going to want to buy, and the people who think it's going to fall are going to want to sell. They probably don't know each other, but that's what a broker or a dealer does. And in a financial institution, it has the network system to match those parties up, and so that they could trade. That's what's happening here. Now, that means we're going to have in the middle between these two parties a swap dealer. And that swap dealer is in the middle. And so let's try to craft a situation where we can satisfy both parties here based on their expectations for changing interest rates. Okay, so now let's go further into the example on page 2 of my notes, and it says here, assume a swap dealer, which is basically a bank, charges 30 basis points per year. So this swap dealer is not a non-for-profit, it's for profit. They're doing this to make money, so they're going to skim some money off the top, so to speak, because they need to make their fees. And the fees are 15 basis points from the fixed payment and 15 basis points from the floating rate payment. So basically, ABC agrees to be the receive fixed. They want to receive fixed. So we'll put in a line that says, look, they want to receive fixed, and that fixed rate will be 5%. Okay, And so this is what's happening. The swap dealer has negotiated or worked with both parties to come up to an agreement to swap. And those fixed rates are going to come from XYZ. Because remember, XYZ wants to pay fixed. And so we can set it up so that XYZ pays 5.15%. There's that 15 basis points that the dealer is taking. So XYZ is paying that fixed rate, and it goes to ABC, and ABC wants to pay floating, so it's going to pay, for example, Libor plus 1.5%. Okay. Now the 1.5% in these interest rates depend on the conditions, the market conditions at the time, and how things get negotiated. So in this case, it's just accepted as is. It's going to ABC agrees to pay Libor plus 1.15%. Okay, and then what happens is that money gets passed through the swap dealer or the broker, and what will happen is Libor plus 1% even ends up going to XYZ. Okay, so this right here in the middle is the swap. Swapping fixed for floating. Okay, so now look what happens. I'm going to get a different color pen here. Look what happens in this situation. ABC has coming into it 5%. It pays 5% to its bondholders. So the net effect of this 5% fixed and payment coming in actually goes out to the bondholders at the fixed rate. They cancel. And ultimately what happens is ABC is now paying a floating rate, Libor, whatever that turns out to be, over the life of the swap. So the swap will have several years of life. It'll pay the Libor plus 1.15%, just as it wanted to do. Okay? Because remember, these guys think interest rates are going to fall, and if Libor falls over the life of this swap, and by the way, the life of a swap is called a tenor, T-E-N-O-R, tenor. So over the tenor of this swap, when rates start to fall, this L falls, and so these guys end up, the net effect is these guys are only paying a low rate. Okay? Now, from XYZ's position here, they want to pay fixed because they think rates are going to rise. And so let's see what happens here. Look what happens. XYZ is receiving Libor plus 1. It's paying Libor plus 1 to its bondholders. Those two things net. And it ends up paying this 5.15% fixed. So it matches its desires. And so that's what a swap does. It allows companies to swap fixed for floating based on their expectations of where interest rates are going. And so that's the outline or a map of what these interest rate swaps will do. Now we want to get into more detail. Look at timelines, because there's no timeline really here. I mean, I talked about the tenor being a couple of years, but we need to map out the cash flows, and we need to determine, how do you figure out these interest rates? That's called the swap's fixed rate. Ignoring the 15 basis point thing, the 15 basis points fee basically, the swap fixed rate is 5%. Where does that come from? And what is Libor all about? Well, that's what's coming up in the chapter. So let me now. So what we want to do is take this structure that we have here, and let's actually put it on a timeline. So here's ABC, and ABC has bonds, and here's the bonds that have been outstanding. 0. We're going to assume this is an annual paying. These bonds pay annually, only for simplicity. nearly most bonds pay semi-annually, and when you get into swaps, they're often quarterly payments, but that just makes things harder. Let's just deal with annual for now. And so these are outstanding bonds to ABC has outstanding to its bondholders, and it pays. So I put the down arrow. It's paying to its bondholders. It's going to pay 5%, 5%, 5%, and 5%. That matches up with this 5% that it's paying to its bondholders. Okay? Now, ABC is going to enter a swap. Okay? It's going to enter a swap, and it's going to receive 5% each period. That's the up arrow, is receiving 5%. And you have a tenor of 4 years here. So we're a little more specific now on the timeline. And then here, there's going to be payments out on the swap. And the payments out are going to be, now here's the notation. Let's get the notation down first. It's a little weird, but you'll get used to it. It means it's LIBOR. We're paying LIBOR through the swap. ABC, when it enters the swap, will pay LIBOR. And that LIBOR rate is determined at time 0. So the LIBOR rate that gets paid here is determined at time 0. It's what I refer to at the beginning of the notes, set in advance and settled in arrears. So what happens is the payments are set here at this period and paid one period later. That's set in advance, paid in arrears. And then there'll be another payment that gets made here, and that will be set at time 1, and so on. So you'll see. So now let's finish up with this notation. And we see that ABC, when they enter the swap, they're going to pay LIBOR, which was an interest rate that was determined at this point. That's what the 0 stands for. And then it covers a 1-year period. So from here to here is 1 year. And so that's what this interest rate covers. And it's known as a spot rate because this is the interest rate that starts on the spot, so to speak, right at time 0 where we stand now. Okay, it's going to pay that variable rate, that variable rate L plus 1.15%. And it's going to keep doing that. So the next payment will be LIBOR with a 1 here, the rate that will be determined here for the next year. And it stands for a 1-year period. Again, from here to here is a 1-year period. So in brackets is 1 plus the 1.15%. And the same thing here. It'll be LIBOR 2. Okay, because the rate will be determined at this point. It'll cover a 1-year period plus the 1.15, and then this will be LIBOR 3 that covers 1 period plus 1.15%. So that's nothing but a timeline of the cash flows associated with the swap. So right away, what you see here is you see money coming out and money coming in each case. And those payments will be net. So whatever those payments in terms of dollar amounts will be, they will net. Now I haven't spoke about how those dollar amounts are calculated, but every swap, just like every bond, has what we call notional value. In other words, what is the face value of these instruments? And so you take the face value and multiply it by the interest rates. And that's how you come up with the actual dollar payments. Because you literally can't swap a percent. People want money. They want you to write a check. They transfer money, not percentages. So you got to translate these into dollars. And that's by multiplying it by a notional value. The other thing you want to look at here and notice is that we're swapping just the interest payments. You notice that? The net payments is what will be swapped. You notice there's no notional value that's being swapped on either end. So when you enter into these instruments, you could swap the notional value at time 0. But what ABC would be doing is ABC would be paying $1 million, and XYZ would be receiving $1 million, or ABC would pay $1 million and receive from XYZ $1 million, it would net to zero. So there's no sense in swapping notional values of a swap. So the point is, it's only interest rate payments that are being swapped, not the notional value. And that'll become more clear. If it's not quite clear now, it'll become more clear when we actually do the dollar calculations. So hold on. Now let's look at the net effect here. So the bonds for ABC plus the swap should net out to variable rate payments. And you can see they do, because this 5% that's going out the door is offset by this 5% going in, as we saw in this diagram. And so what happens is the payment in year one is going to be this L, the spot rate for Libor that covers a 1 year period, plus 1.15%. And in the next period, the net payments, and I should put down arrows because this is what's going to be paid out, is Libor 1 for a 1 period plus 1.15%, and it keeps going. It'll pay Libor 2 for 1 period. It'll pay Libor 3 for this cash flow. Okay? And so there you have it, at the same thing, the same information here, but on a timeline basis. Because why are we doing it on a timeline basis? Because we remember the value of any financial asset is the present value of its future cash flows. And you need to map out the cash flows and then discount the cash flows to present value terms. And so that's where the timeline comes in. It helps us map out those cash flows and the discounting that's going to happen. Okay. So, by the way, your text, and I'll write it off to the side. It has some crazy, your text is crazy with notation. And it doesn't have to be that crazy, but I'll show it to you. And just look, you can just, once you understand the basics of the notation, you can kind of throw it out, a lot of it out the door because it's just too technical. So basically what this is an abbreviation for Libor. And the subscript is the time that it starts out with. And then the difference here, these two time periods right here, that's really the amount of time between, in this case, between each year. So this is a 1 year period in this example. It's TI would be right here, and then TI plus 1 minus TI is just a 1 period that payment covers. I don't like that. It just is a bit complicated. I think you can follow this as I wrote it out. Now, that's ABC. Now what we need to do is let's map out XYZ in the same fashion. Okay, XYZ has some bonds outstanding. Bond, 1, 2, 3, 4 periods. And it's paying right now, it's paying floating. And this is what the payments would be for that company if it didn't enter in the swap. This would, well, even if it's in the swap, and I'll explain that in a minute, this XYZ has to pay these Libor rates 1 year from now, this Libor rate 2 years from now, and this Libor rate 3 years from now, and this one 4 years from now. That's the payments. We don't know what those Libor rates will be. For most of these, we don't know exactly what those Libor rates will be. That's the uncertainty involved in the financial markets. Okay. Now, XYZ enters into a swap. And what it does is it pays 5.15%. And that's pays out. It's the negative arrow. And then it receives the Libor plus 1. Okay? It receives Libor plus 1. and so on. So it'll be the same rate here that it'll be paid. And so the net effect of having the bond plus the swap, and sometimes this is called an overlay, because we're leaving the bonds in both cases for these companies. We're leaving the bonds outstanding in the credit market. So those bonds stay outstanding. It's just that ABC and XYZ, they enter into swaps, and basically it's what's sometimes called a layover. You have a bond, you lay the swap over, and then the net effect will be, in this case, it'll be the company paying 5.15%. And why is it paying a locked 5.5 or 5.15%? Because it expects rates to go up, and it wants to lock in the rates while they're low at this point. And so what happens is XYZ just financially, through some financial engineering, took its risk that it has here, and the risk is that interest rates are going to go up, and it has floating rate bonds already outstanding, enters into a swap, lays it over, and then the net effect is it's paying that fixed rate. What's really cool about it is, you know, XYZ could call its bonds. What calling its bonds means is it could buy them back in the open market or from bondholders. But it turns out to be quite expensive. It's much cheaper to lay a swap over top of the company's financial structure, so it nets out to something nice and simple, instead of having to call back, it could be hundreds of millions of dollars worth of bonds, which would be quite expensive. Okay. So now what we need to do is let's discuss a bit, you know, where do these fixed rate payments come from? Okay, so you can see Libor. Libor is just an index, a bond, or an interest rate that we'll explain a little bit later. But that's an interest rate that varies over time, just like the Fed funds rate varies over time, just like the Treasury bill rates change over time. But the fixed rate, that's the key to pricing swaps. So when we value a swap, or what's called pricing a swap, it's all about determining the swap's fixed rate. In this case, these numbers. And so that's called, the label for that is capital R. It's denoted capital R. That's what we want to solve for. Okay. Now, we solve for that rate R, and that is certainly of value, knowing that. But there's also some other information that traders like to know, and that is the swap's spread. And the swap's spread is equal to R, the rate from the swap, minus the rate of a treasury bond with the same maturity as the swap. So the spread is the interest rate on the swap minus the treasury rate for the same maturity. In this case, it would be a four-year treasury versus the 4-year swap fixed rate. And those are called spreads. Everybody knows what a treasury rate is. They just look it up. It's posted in financial websites all over. And so sometimes just having the spread is enough for traders to be able to trade, because they know what the treasury is. Or in some cases, people just look at what is the swap fixed rate, and they can back out the treasury and come up with the spread. Okay? But that's just two different ways of portraying the same information according to traders in the market. Okay? Now, by the way, yield curves, and we'll get to this in a few minutes after I do after I do another example. But we talked about yield curves a bit, and remember, yield curve is maturity versus a yield. Okay, and so you can have a treasury yield curve where you have treasuries, and that's the most common yield curve in the world, a treasury yield curve. And that just says, look, you got 3-month treasury bills, and they're, you know, right now, today, they're about 2.40. And then you have 1 year, and then you have 5-year, and you have 10-year, and then you have 30-year treasuries. It's not linear in across the scaling, but that's just the way it's done. So you got interest rates here for 3 months. 1 year is a little higher. 5 years is a little higher. 10 is a little higher. So you often have what's called an upward sloping yield curve. All it does is it maps and shows you that as maturity goes up, interest rates are going to go up in this case. So a lot of people look at this and say, oh, you know, the yield curve is upward sloping, then interest rates probably are going to go up in the future. And then if you had a yield curve that's what's called inverted, downward sloping, people would expect interest rates to fall over time in the future. Okay? So now the point is, you could have a swap yield curve showing R, the swap fixed rate. Okay? Change this out and put swap here. In the swap, you'd have different numbers, but you'd have swap fixed rates. Or you can just map out the swap spread in terms of maturity. So you have two different yield curves that you can deal with swaps. And there's probably more than that, but the primary ones are showing the swap fixed rate over maturities versus, and the other is showing swap spreads over various maturities. Okay, let's do another example where we can motivate swaps a little more, and then jump into the convention that most swaps pay quarterly. So we got to adjust and learn how to handle quarterly payments and get the notation down for quarterly payments. And that's where we're going next. The example is as follows. A bank currently holds a 1-year loan with a principal of $12 million. The loan generates quarterly interest payments based on 90-day T-bill yields plus 200 basis points. So as soon as you see that, you know this is a floating rate loan, right? Because it's based on 90-day T-bills, and however 90-day T-bill rates materialize over time, that's the payments that are going to be generated by this loan and go into the bank. The bank's asset liability department, and by the way, every bank has an asset liability department to manage the interest rate risk associated with the bank. And they often use swaps and other derivatives to financially engineer the bank so that its interest rate exposure is net to zero. So, in other words, if interest rates rise a lot or they drop a lot, the net effect on the bank's income statement will be relatively small. And so that's what asset liability companies do in banks. It's required by the regulators that they have such a department. Okay, this asset liability department believes that interest rates will fall over the next year and would like to synthetically alter the payments on the loans it holds. Okay, so interest rates are going to fall. That's bad if you hold a variable rate loan. Okay, the bank could try to call the loan in, but that would be bad business. The customer probably would not want to deal with the bank again. So what's going to happen is the bank has this existing loan, is going to enter into a swap, and then it's going to change those variable rate payments that it's receiving, and it's going to flip them into fixed. So if interest rates fall, like the asset liability department thinks, they're hedged against that risk. Okay, a 1-year swap rate offered by a dealer is 3.25%. That's capital R. So capital R in this problem is 3.25%, simply given to us at this point. We'll address how such rates are calculated later on in this video. Okay, so the swap rate offered by a dealer is 3.25% with floating rate payments equal to 90-day T-bill rates plus 1.65%. 1-year T-bill rates are 3%. Okay, using three timelines, map the payments the bank will make on the loan, the swap, and combined. Okay, so let's map out the loan. The loan, not that hard. And by the way, what we're going to see in this is, we got to get comfortable with the fact that many swaps pay quarterly. And so we got to get comfortable with notation and how to deal with quarterly payments. And so we're kicking up the complexity ever so slightly in this problem to deal with that. And we're also changing, we're getting out of Libor, and we're indexing these rates to T-bills instead of LIBOR. And so now here's the loan. So if we mapped out the loan in total, so let's actually look at the loan in total. The bank made a $12 million loan, and so I put the down arrow there when it initially made the loan. And then it's going to receive $12 million when the loan matures. Okay, that's just background here. So that because that's not going to change. That loan is going to stay in existence. Now over the life, even if we have a swap. Now what's going to happen here is I'm going to use T for T-bill rates. For Treasury bill rates, and it's going to be T0, and the 0 stands for, the interest rate here at time 1, which is actually 90 days out. This is the first quarter. Again, it's set at time 0. It's paid at time 1, and this is how you portray a T-bill, a 90-day T-bill. A T-bill rate that's determined today that covers a 90-day period, this period right here, between my fingers, plus a 2% added on, 200 basis points, as the problem states. The next payment, we don't know exactly what that payment will be, but we can write it out symbolically. That's going to be the payment that's determined here on this 90-day period. It ain't 90 days out. It's going to cover a 90-day period here, between my fingers, and then it's going to pay a fixed 200 basis points on top of that. And then this rate here will be T180 for a 90-day period plus 2%, and the payment here will be T270 for 90 days plus 2%. Okay, so those we just mapped out the cash flows as best we could because we don't know exactly what the numbers will amount to be, but we can put them down symbolically. Now the swap here is going to have the same life, and by the way, a bank would probably never do this for 1 year, but they would do it for multiple years. But I'm not going to do like 5 years worth of payments on a quarterly basis and try to crunch out 20 quarterly payments on paper. It would take me forever. So you can extend out in your mind how things would work with longer term maturities. Okay, so now the swap here is designed so it's 3 1/4. The swap's fixed rate that we're going to receive is 3 1/4%. Easy to map out. The payments that the bank will pay, and that's the down arrow, will be the Treasury bill 0 that covers a 90-day period. Again, it's covering this 90-day, the first quarter, plus 1.65 according to the example. Okay, and then this one will be 90 plus 1.65, and this will be 180 plus 1.65. And this will be T270 plus 1.65. The net effect, combined net effect, would be simply adding up these payments. Go vertically. Add up the payments. Add up the payments. Add up the payments. If you add up the payments, the T's cross out. You notice that the T's are going to cross out because you're receiving it through the loan and you're paying it through the swap. That nets out. You're going to have plus 2 minus 1.65 plus 3.25%. That adds up to 3.60 is what's coming in the door net when you add up these two instruments, the loan plus the swap. Okay, and then don't forget you're going to get $12 million here at the end. Just call it plus 12 million. 12 million right here. And net, there was a negative 12 million that went out the door at time 0. Okay, so notice what happened. When you net all this together, the bank is now receiving fixed. And that's exactly what it wanted to do because it was nervous that rates were going to come down and this interest income would have dropped. But instead it's fixed across the way. And so the next question is, what is the swap's spread? Well, you know, you're looking at this, it's like, holy mackerel, how the heck do I figure that out? But it's easy. The spread is, by definition, the swap's fixed rate minus T-bill rate. This is the swap covers a 1 year period, right? So we have a 1 year swap, and then we have a 1 year T-bill that we're subtracting it out by, reducing it by, and we get 25 basis points, or 0.25% is the spread for this swap. Okay, now what we want to do is let's move into term structure of interest rates. Anybody who's interested in bonds and bond market and finance in general has to have a grip and handle on term structure. So it's covered in basic finance, and I know that because I've taught it for a couple of decades, and you know, I had it when I was an undergraduate too, so I know term structure is all over basic finance. So whatever basic finance course you had to have seen term structure. But I'm going to cover it anyway because I want to make sure that we have a good handle on it because we're going to use it. And understanding term structure is important to pricing swaps, and for that matter, pricing any instrument, any interest rate sensitive instrument, like a loan or a bond, and so on. So let's make the digression. So first thing we want to do is, and I'm on page 6 of my notes where we talk about this as a digression for a few minutes. We're going to first define what a spot rate is. A spot rate is the interest rate that you can see on the spot, so to speak, right now. So if you have a spot rate, okay, the spot rate starts today, which we always designate as time zero, and if we do this quarterly, or this could be annual. I don't care if you look at it quarterly or annual, as first quarter, second quarter, or third year. Then the spot rate that covers the first year or the first quarter, that's a spot rate. And then a spot rate that covers a 2-year period is covering that area of the yield curve. And a 3-year spot rate would cover starting today all the way out the 3 years. Okay, spot rates all start on the spot, which is why each line starts at time zero. Now, those things are great. We're going to use these spot rates that you can determine right now and see right now. We are going to use them for discounting cash flows. Okay, so we're going to discount when we come up with a 1 year or 1 quarter cash flow, and we want to discount this cash flow back to time zero. We're going to use this 1 year spot rate. And if we have a 2-period cash flow in period 2, we're going to discount it back on the 2-period spot rate. If we have a cash flow here at period 3, we're going to discount it back at the 3-year spot rate. Okay, so that's the first important thing you need to get a handle on here. And so notice you see term structure, the structure of interest rates over terms, maturities into the future, time. Now, what's of importance, an interesting question is, okay, if let's just assume this is annual for simplicity purposes. This is annual. What is going to be the interest rate if today is, let's say it's April of X1, right? Year X1. Then what is the interest rate in April of year X2, 1 year later? What is that interest rate for 1 year? What is that rate going to be? Well, you don't know what that rate's going to be. You won't know until April of X2 pops around. So that is what's called a forward rate. A forward rate is an interest rate that starts in the future, in this case 1 year from now. In this case, it covers 1 year. Okay, starts 1 year from now and covers 1 year. You could also look at a forward rate that starts 1 year from now and covers a 2-year period. That would be a 2-year forward rate. You could look at a forward rate that starts in year 2 that covers a 1-year period out. And so you have a combination of spots and forward rates representing term structure. The spots you can spot with your eye, as I like to say it, but the forward rates are embedded. They're implicit. You can't really see them. You have to mathematically back them out yourself for term structure. And you have to back out these other interest rates, these forward rates. Spot rates, you can see. And we already dealt with spot rates. We called it, for example, L0, and that would be the interest rate that starts on the spot, covers 1 year. This 2-year spot would be L0 and covers 2 periods all the way out. And then you could have L03, and that would be this covering this period. Okay? So that's what forward rates are. And so, by the way, you can enter into, as we'll get to later, you can, you don't know what these interest rates are going to be, so they're risky because you don't know what they're going to be. You can enter into a forward contract to lock these rates in, if you like, using a forward, kind of like a futures contract, except it's a forward, it's a negotiated instrument. And so forward contracts that work based on interest rates are called forward rate agreements. So you can lock in various interest rates in the future. And we'll cover those shortly. We will cover those shortly. Okay? Kind of like a regular forward contract, but instead of it being a commodity price like corn, it's an interest rate. And when you have an interest rate, this makes things get 2 extra complications involved. One, you need to have a notional value, like a face value. So you need to take the interest rate and multiply it by a dollar amount, because you just can't trade interest rates. You don't write a check out for an interest rate. You got to write a check out for dollars. And money moves, dollars move, not percentages. So we need to have a notional value to translate the percentages into dollars. And then the other thing is you need to know the time periods involved in order to calculate the dollar amounts of the interest payments. Okay? So that's just a teaser as to what forward rates represent, forward rate agreements. Okay? They're basically forward contracts on interest rates. Now, what we want to do, and this is going to be a number of little calculations here that are repetitive, but I'm going to show you a Libor yield curve. So I'm going to represent this mathematically in a table. And I'm going to show you the Libor yield curve. We are going to be given spot rates. So spot rates will be given. We're going to compute these forward rates here. Okay, and then from the information that we have from these spot rates, so from the spots, we start with spots, calculate the forward rates, and then from the spots, we're going to calculate discount rates, the discount cash flow back to time 0. So we're going to get cash flow in the future. We need to calculate its present value, and we're going to use discount rates to do that. They come from the spots. So the spots are the source of forward rates, and the spots are the source of discount rates for discounting cash flows back. Okay, I am on page 7 of my notes. It says example. Libor yield curve shows X-day spot rates in the second column below. So let me show you what's happening here. Okay, so what I just did was I dropped everything in a table, in table format. So here's the example. It's basically, we're giving you maturities, and these are in days. And then we're giving the spot rate here in the second column. And then we're going to compute forward rates, and then we're going to compute discount rates that we need to compute present values. And the first thing, notice how I wrote out the notation here. The spot rates always start off at time 0. So when you have a 0 subscript here, you know it's a spot rate. And this is the time period it covers. So this covers a 90-day period, a 180-day period, a 270, 360, and here's the interest rates associated with it. Okay? Let me show you what that looks like in the timeline for a second here. So we've got a timeline, 0, 90, 180, 270, and 360. And by the way, convention has it that each year has 360 days, so that every month has 30 days in it. It's just convention to make the math easier. The bond world has been around for a very long time, way before computers and calculators. And so math had to be calculated by hand or using tables. And so they used simplifying methods. And so that's why there's a convention of 360 instead of 365 for a number of days in a year, just as background. Now, according to the information here, the first spot rate, this is 4%. Okay, that covers the first 90 days, right? See, 4%, 90 days. And the spot rate here for 180 days was 4.25%. Okay, maturity is 180, and it starts right here and covers this 6-month period. And then the next interest rate for 270 covers this whole period, and that's 4.45%. And then the final spot rate is 5%, according to the table. So that's it graphically. And now we want to determine the forward rates. The forward rates are, what is this interest rate, what is this interest rate, and what is this interest rate? That's what we want to know. We could calculate other forward rates, like 2-year periods, but we just want to stick to quarterly. And so that's the question. What are these rates here? And so these rates can be backed into given this information. And that's our goal. That's our goal, to figure these out. But there's a Libor convention that needs to be used when you do swaps. So there's a method for calculating these forward rates using what's called the Libor method. And so let me show you what the Libor method will do for us. But before I do that, let me show you the formula. And then I'm going to ditch the formula pretty quickly because I think it's one ugly looking thing. And you'll figure it out without getting into all this nonsense of subscripts and superscripts and brackets and time periods. This is the formula in the text. And so it takes 1 plus the Libor rate, the spot rate, adjusts it for the time period involved, right? And then it divides it by 1 plus the Libor rate adjusted for the time period involved, and then subtracts 1. You can try using that and putting it on a formula sheet for a quiz or an exam, but it's almost a waste of time. It's just too ugly. So follow along with the intuition, and the intuition will guide you on how to solve this problem. Okay, so the forward rates that we're going to calculate, this number, these 4 numbers right here. Now the first trick is really easy. The first forward rate is a trick basically, and what that means is the first forward rate, L0 to 90. Technically, by the way, so what I'll show you graphically. I told you these are forward rates, and that's true. But technically, there's a very first forward rate. Okay, the first forward rate is the spot rate for this period. Okay, so technically there's 4 forward rates, and this very first one is simply the spot rate. So there's no calculations involved. So you just transfer the spot rate as a forward rate. Okay, and then what we have to do is we have to calculate the forward rate, this forward rate. Now, let's calculate this forward rate. And the way we're going to calculate this forward rate is using this information and this information, we can back into this guy right here. And that's where we're going, backing into it. The forward rate covers a 90-day period. Okay? So how do we do that? Well, let me get another piece of paper to write this out. We're going to take 1 plus the 0.4025. That's the spot rate for 180 days here. This 4.25%. And we're going to adjust it for the fact that, look, this covers a 1 year, this covers a half a year. So this 4.25% is a 180-day spot rate. So it's consistent with the spot rate. So these are always on an annual basis. Remember, interest rates, as we've talked about before, interest rates are always on an annual basis. And so we have to chop them down to put them, in this case, adjust it for the time period involved. So this spot rate covers a half a year, and so we're going to multiply it by 1/2. Okay? And then we're going to take it, and we're going to take 1 plus the interest rate, the spot rate over this period. Okay? Or another way to show it is, we're going to take this rate here, put it in, adjust it for the fact that it covers a half a year, and then we're going to take the 4%, right, and adjust it for the fact that that covers a quarter of a year. So we're taking this, adjusting it for a half a year, this rate, adjusting it for it's only a quarter of a year, and we divide these out and subtract 1. Okay? And we subtract 1. Right? Now we get something that we have to readjust to get it on an annual basis. So we get it on a quarterly basis here. We subtract the 1s to get rid of this one here. And then we multiply it by the fact that we want to get, we want to take this quarterly number. So basically, when we have 180 and 90, subtract those two. This is a quarterly interest rate that we're calculating. So we need to multiply it by 4, basically, to get it back on an annual basis. So really what I'm doing is I'm looking at this ugly thing right here, and then adjusting it to get it on an annual basis, to annualize. Okay, annualize. And that's what I'm doing. So all you need to do is take the longer maturity, divide it by the shorter maturity, make sure you got the right days in there, and make sure you got the number of days that you're covering, and adjust it to get it on an annual basis. And when we do that, we come up with 0.04455. Okay? And so the answer here to this forward rate is 4.455%. Okay? Now, that is the first forward, that's the second forward rate in the table. Now what we want to do is let's calculate L180 90. Okay, what is that interest rate? And graphically, whoa boy, where is it? Here it is. Here it is. We want to, so this is 4.455, and now we want to know what is this guy right here. And we're going to calculate this rate. Whoa, we're going to calculate this rate by using this 4.45 over a 270-day period and dividing it by this 4 1/4, which covers a 180-day period. The difference between 270 and 180 is the 90 that we're worried about between my fingers here. And we're going to and then we have to annualize it because we're going to put term structure, and term structure is almost always written on an annual basis. But we got to fool around with the fact that these things pay quarterly. Okay, so let's do the math. Another calculation here. We're going to take 1 plus the 0.0. Let's see, where did I write that out here? 1.45, okay, 4.45. We're taking this interest rate. There's a lot of numbers flying there. We're taking this interest rate, 4.45, adding 1 to it, putting it in decimal form, by the way, and we're going to divide it by the 4 1/4. Okay, so this is for 270 out of 360. We're going to divide it by 1 plus 0.0425, adjusted for the fact that that covers a half a year. Okay, now we're going to subtract 1, and then we're going to annualize it. And we're going to annualize it 360 divided by 90 because look, we have 270 days and we're dividing by 180 days. Technically, this number in here is on a quarterly basis. So we got to take this quarterly number and annualize it by multiplying it by 4, basically. And when we get that guy, we are going to get 0.04749. And that is our forward rate here, 4.749. And our next number is this last forward rate, which graphically is this number. So this number right here is 4.749. What is this next forward rate? The last forward rate in the calculation? Well, 1 plus. And again, it's repetitive, so these things get very repetitive. We're going to take this 360-day 5% rate, divide it by this 270-day rate of 4.45. We'll end up on a quarterly basis, and we'll have to multiply it by 4 to get it to an annual rate. And that number comes out to be 0.6435. So this number, this rate becomes 6.435. And our table is 6.435% for that last forward rate. Okay, so then now we know what the implied interest rates are going into the future. Okay, these are forward rates that we expect to happen. This we know will happen because that's the spot rate. We know this first one will happen, but these are uncertain. It all depends where Libor goes. But given the way the structure of the term structure is set, right, it implies that these are the forward rates that prevent arbitrage. So we've designed this so that it's arbitrage free. And what I mean by that is, you go back to this graph here. What we just did mathematically is we are indifferent between this 6-month rate right here of 4.25. We're indifferent between investing our money at 4% for the first 90 days and rolling it over into 4.455% for this period. Okay? It's arbitrage free. We're indifferent between investing for 90 days and rolling it over for 90 days, or just locking our money up for 6 months. The same thing applies with these other rates. So we can invest our money at 4.45% for 270 days, or we could invest our money for 1 quarter at 4, 1 quarter at 4.455, and 1 quarter at 4.749%. We're indifferent between the two scenarios. And rolling it over 3 times, or rolling it over twice, versus investing for the entire time period. These are no arbitrage conditions, and mathematically we resolved it by simply doing some relatively simple math to prevent arbitrage from happening. Okay, so now what we want to do is, you remember, we're in finance, and nearly everything we've been doing since the beginning of the semester is we've had to discount cash flow. So we get cash flow, we need to discount it. So we're going to get in cash flow in these periods, and we need to bring it all back to time 0 money. So we need discount rates in order to do that. Well, where do those discount rates come from? The discount rates come from spots. Okay, so we're going to calculate these rates from spots. This calculation is not as hard as calculating the forwards. So, slightly different notation now. Now, let me show you the notation. is going to be, these discount rates are going to be labeled B, TI equals 1 over 1 plus L0, that's the spot rate, TI times TI over 360 to adjust it for fractional periods of a year. Okay, so what the B stands for is this is the price of a discount bond. Okay, a discount bond, a $1 discount bond. So before we get into crazy math, let's just look at it. You know, you're going to get $1 in a year. Let's do it on an annual basis. Okay, if you have to discount that back, right, and you're going to figure out what is that dollar worth today. So this is in 1 year you're going to get $1. What's it worth today? And if it turns out that this is 0.96, then that is the price of a $1 bond, a discount bond that pays off $1. Okay, 96 cents will get you $1 in 1 year. And so this would be, it would be denoted as a bond price, a discount bond price on a dollar basis. And then you can always multiply everything up by the notional value to get it into an actual dollar amount that people are going to write checks and electronically move money for it. Okay, so that's what we're doing here. The formula is this, but again, this is a kind of a nasty, ugly formula that you ought to be able to wrap your head around without having that formula. So what I'm going to do is I want to calculate the first discount rate here. What is the discount rate here? And again, we're getting a cash flow at 90-day period. How much do I discount that cash flow by for that 90-day period? So I'm going to take 1 plus, divided by 1 plus 0.04, this 4% spot rate right here, this 4% spot rate here. And I'm going to adjust it for the fact that it only covers a 90-day period. Okay, so I'm going to adjust that 4%. So that's basically 1% over a quarter of a period is what multiplying that out means. So the discount rate will be 0.9901, the discount factor, I should say, the discount factor. So in other words, if you're going to get a $1, if we're going to get $1 in 90 days, right, and the spot rate is 4% on an annual basis, which really translates into 1% for the quarter, then this $1 that we're going to get here is worth 99 cents today. That's what that says. It's worth 99 cents today. And now we need to know, well, what are we going to get in 6 months from now, and 270 days from now, and 360 days? What are those discount rates? So that's what we're going to calculate next. So this, by the way, is 0.9901. Let's calculate the next rate here. And that next rate is simply 1 plus 1 over 1 plus 0.0425 times 180 over 360. So we're taking this, see this 180-day spot rate? That's the 4 1/4 right here, adjusting it for the fact that it's a half a year. And we get that we turn out to be a discount factor of 0.9792. So we would spend about almost 98 cents, right? If we spent 98 cents today, in 6 months we'll get $1 because we earned a rate of 4 1/4%. Okay? And then you have to adjust it for the quarterly basis. Okay? So now this number is 0.9792. And you notice the discount rates are falling, which makes sense. The next discount rate recognizes the fact that it's a 3-month or a 3/4 period. And so that comes out to 0.9677. And then the last one would be really no adjustment because it's 1 year. Multiplying it 360 divided by 360 doesn't do anything. and that's 0.9524. So therefore, our discount rates are 0.9677 and 0.9524. The discount rates are declining. That makes sense. Okay, so what did we just do? Just to recap for a second. We were given maturities. We were given spot rates because that's what we can spot. That's what we're given usually. We calculated forward rates. The math was a little tedious, but we did it. And then we also calculated discount rates. Okay? And so what we need to do now is we need to employ this information. And we will later. So this is the background. Let's look at a forward rate agreement. Before we go any further, we will look at a forward rate agreement using these numbers, particular numbers here. And then we'll go into an actual swap example. Okay, the example is given the forward rates from the table above, in other words, this table that we have right here, we can now describe the mechanics of a forward rate agreement. So remember, forward rate agreements are basically forward or futures contracts. Instead of exchanging a price, like the price of corn per bushel, we're swapping interest rates that need to reflect a notional value and a time period. Because if you borrow money for a second, there's really no interest rate associated with it. So you got to have an interest rate, a notional value, and some sense of time in which the money is borrowed for or lent. Okay? So now suppose you expect to receive $10 million in 90 days, but are concerned that despite the upward sloping yield curve, rates may drop. Wait a second, upward sloping yield curve? Exactly. Look, interest rates are expected to go up. So that's what we mean by an upward sloping yield curve. The interest rates in the future are expected to go up. These guys right here. So it's 4%. It's going to go to 4.44, 4.455, 4.7, 6.4, and so on. That's an upward sloping yield curve. Rates are expected to go up in the future. Okay? You plan to invest the money that you're going to get for 90 days. So you expect to get $10 million in 90 days, and you want to invest the money for 90 days. The expected future spot rate denoted as L90 90 equals 4.455%. That's what we calculated a few minutes ago. So you enter into a forward rate agreement to receive fixed. Okay, you want to receive fixed and pay floating because you expect rates to drop and you want to keep that high, and earn that 4.4% and hope that rates fall. Okay, so you want to enter a forward rate agreement to receive fixed, pay floating, starting in 90 days for 90 days. The spot rate 90 days later turns out to be, in other words, gets realized, turns out to be 3%. So this is what we expect, but it actually turns out to be, this is what the yield curve anticipates. But it turns out to be that we were right. Interest rates do fall, so we should make a profit from this transaction. Let me map it out for you here. Blow it up a little bit on a timeline. So we expect to get $10 million. So we're right here at time zero. We expect to get $10 million at this point. But the problem is we're sitting right here now, and boy, we think, contrary to the upward sloping yield curve that's in the market, you know, we're smart, we're actually contrary to the market. We think rates are going to fall. And if rates fall, that's going to hurt what we can get out of this 10 million for this quarter of a year. So what we want to do is we want to lock in this interest rate and pray that rates fall. Okay? And so let's do the math then here. So the math would be the gain or loss, I'll call it GL to this forward rate agreement, gain or loss, is equal to, let's do it symbolically or writing it out. Notional, you have the notional value, which is 10 million in this case. We have the fixed rate, okay, the locked in, that's the fixed rate that's locked in. We have the floating rate, which is what actually gets realized. We don't know what it's going to be yet. That's not locked in. This fixed rate is what's locked in. We need to adjust it for the time period because it's only a quarter of a year. So writing the numbers out, we've got 10 million notional value. Remember, you need a notional value. You need an interest rate here. We're going to receive, so remember, we receive fixed and there's implicitly a positive sign. We're paying floating. That's why there's a negative sign here. So we're going to pay this. This is what actually turns out to be. We're right. Interest rates went and fell. So we're going to make this difference, adjust for the quarter of a year, and we will make $36,375 on this forward rate agreement. Had we have been wrong and rates would have went up to 6%, this amount would have been negative, and this amount would have been negative. We would have had to pay money for this forward rate. So as it stands now, we entered into a forward rate agreement, and in 90 days, you know what we're going to get? We're going to get a check for $36,375. Okay, a couple of comments on LIBOR and forward rate agreements before we calculate the floating rate payments, you know, back to the swap that we were dealing with. Do not lose sight of the fact that LIBOR is an interest rate on euro-dollar deposits. Okay, what that means, what euro deposit dollars are, is they're deposits that are denominated in dollars, but the deposits are actually made in the UK. Okay, the maturity structure of euro-dollar deposits are basically much like our money market system here in the U.S. It's 30 days, 90 days, 180 days, and so on. And similar to our CD structure here in the U.S., CDs are sort of like a money market instrument. They are a money market instrument. So the euro-dollar deposit market is a wholesale market. It's traded in millions of dollars. You can't really do it at a retail level, from my understanding, and that's not what we're worried about here, retail or wholesale. But just keep in mind, usually the euro-dollar deposit market is in big money minimums to make these deposits. And so it's kind of like you going over, or you or a business going over to England and taking your dollars with you and depositing them into a bank account. You don't have to flip the dollars into pounds first and then make the deposit. You literally deposit the dollars. And so the interest rates associated with that are LIBOR, and they're LIBOR are interest rates that are associated with the US dollar as being the underlying. So the other thing you want to also keep in mind is, if you look carefully at that forward rate agreement I just dealt with, basically a plain vanilla interest rate swap is a series or a portfolio or a package of forward rate agreements. On any given payment throughout a swap, so you look at the payment period on the timeline on a swap, you basically have a fixed and you have a floating, and you net the two together, you multiply it by a notional value, you adjust it for a time period, and what do you know? You have a payment. Well, that's exactly what a swap is. It's a series of those forward rate agreements. We'll discuss forward rate agreements a bit further in the next chapter. Let's compute the floating rate payments. Floating rate payments, and we're going to be receive float in dollars, and we're going to pay fixed in dollars. We're going to calculate a net in dollars, and I'm running out of room, but we're going to put net discounted, because we need to discount the net amount in dollars. And it's this bottom line that's going to net out to zero, basically, is where we're going. In other words, the present value of the cash flows will net to zero if interest rates pan out exactly like as is expected in the yield curve. So what we're going to do is let's calculate the first payment, and that's a $10 million notional value. Chop off all the zeros there. Multiply it by the 4% spot rate, remember? And that's the very first forward rate. Adjust it for, it's a 360. It's a quarter of a year, 90 over 360. And so that payment will equal $100,000. And that's what we expect to receive floating, okay? And then we expect to pay $122,500 each quarter because it's fixed. Okay? And that payment, by the way, is calculated as $10 million, 10 million times the swap fixed rate that we're going to learn how to calculate in a few minutes, but I'm just giving it to you. It's 4.9%. It's given in the problem. And then we need to adjust that for quarter of a year. And so that payment will equal, it'll be negative payment because we're paying this rate out, $122,500. Okay? And then, by the way, that'll happen each period, each quarter. We're going to make the same payment. And there we have the payments for the fixed. Now, we net the two here, and this is minus $22,500. Okay? Now we need to calculate the present value of that, and that's where the discount rates come in. We're going to take this $22,500 and multiply it by 0.99. Okay, so 99% of that basically comes out to be 22277 negative. Okay, and that's the present value of the first payment. Now we're going to calculate the next payment, the second quarterly payment, and we're going to use the forward rate that is in existence here. Okay, and that forward rate, let's see. Okay, so remember back in this graph here, we just paid that 4% at this point and discounted the present value. That came out to be total, after we netted everything, negative 22,000. Now we're going to calculate the payment here based on the 4.45% and discount it back. Okay, so calculating the 4.455, adjust it for a quarter of a year, and the floating rate payment that's expected to be received is $111,000 netted against the fixed rate that we're paying, and we will pay a net $11,125. The present value of that, payment, discounted based on this discount rate of 97.92, will be minus 10,899, and then the payment 270 days out will be based on the next forward rate, adjusted on a quarterly basis. We subtract out the fixed payment. The net is minus 3,775. And that comes out to be the present value of that, discounted at 0.9677 off our table, is minus 3,653. And then the last payment okay, that's 6.4%, adjusted on a quarterly basis. That's 160,875. We netted out the 122. Net, it's positive 38,375. Take the present value of that based on the discount factor of 1 year that we computed earlier. And if you add these up, right, there is, as I have in the notes, like a $275 rounding error that I have, which is pretty good. I mean, students often ask me, oh, I got a $275 rounding error. And it's like, look, guys, this is immaterial. We're talking about notional values of $10 million. When you start having $10 million and you start rounding things, by the time you work things out, it's no wonder you're off by like $1,000. I mean, as a fraction of what we're dealing with, it's like peanuts. So don't be disturbed by a couple $100 rounding error when you're dealing with millions of dollars in notional value. And so I essentially call it zero. And so what did we learn from this example? We said, look, what we learned is that a swap's fixed rate, that 4.99%, that swap fixed rate that was given, it's designed and set up so that the present value of what we expect to pay and versus what we expect to receive are equal, so that the cash flows on a present value basis are zero. Okay? Now, like I said earlier, the chances of these actual rates materializing is like it's zero, basically. Only by happen chance would that happen. Because what happens is people have expectations right now about the term structure, but there's going to be all sorts of news coming out from the Federal Reserve, changes in the economy, inflation, things going on in Japan, in Europe, Greece, Spain. All of these factors are going to push interest rates up and down, and so the chances of the interest rates actually materializing to these rates will be, almost no chance. But in order to have an arbitrage-free swap, the swap has to be priced off the term structure of interest rates. And that's what we did. We set up a structure here so that the interest rates and the payments come from the term structure, and when they're calculated, everything nets out to zero from the start. Time zero, present value of future cash flows equal of inflows equals the present value of outflows. And there's no arbitrage conditions. Now, as we will see later, not immediately, but we will see later, when interest rates start to change, just like with forward contracts and futures, then this value of the swap contract, it's going to not be zero. You're going to have gains and you're going to have losses. So swap is a zero-sum game. Somebody's going to win, somebody's going to lose. And so that value will now be on your balance sheet. Because when you first think about it, when you first go into a swap and the value is zero, the net effect on your balance sheet is zero, because your receivable and your payable net to zero. So you would put that as a footnote in you footnote it in your annual report from an accounting perspective. And then as time goes on, you're going to have value. And if the value is positive, it's a receivable, and the value is negative, it's going to be a payable, and that will show up on your balance sheet. Okay? So now what we want to do is we want to look at how do you actually calculate the swap fixed rate, capital R, this 4.9%. How does that actually get calculated? I gave you the answer, so that's the answer, and we can see it's the answer because it sets the present value equal to zero. But how do we come up with that? Well, the simplest way to think about it, and I think the simplest way to think about it and to cut through all of the math, I'm going to show you the math, but you can slice through this math analytically and think about it. This 4.9% is basically an average of these forward rates that are coming up. Okay? Think about it. You're going to have floating and you're going to have fixed, and these floating rates are based on these rates, and how are you going to come up with a fixed payment so the whole thing nets to zero over here? It's nothing but an average. But the averages are kind of hard to, when you deal with compounding of money, and you're also dealing, in this case, not just compounding of money, but you're dealing with this Libor convention of discounting. It's a little funny, but mathematically, it's basically an average of these numbers, okay, with the geometric and averaging involved in there. I mean, we can actually calculate the average really quickly. If we just took an arithmetic average of the 4.4, 4.7, 4, and 6% here, these numbers, we add them up and divide by 4, we get 4.92%, which is a really good approximation of what the number comes out when you use the Libor process of calculating a swap fixed rate. But okay, so that's the intuition. Let's actually do the math, and that's on page 9 of my notes under the heading of pricing interest rate swaps. Now the math gets a bit crazy. I'm not going to show you all the calculations in the video, but in my notes they're all typed out. And what you find out is, if you look carefully at my notes and look at the text, you'll find out that there's a shortcut formula that the text provides. Now, the textbook formula, the shortcut, is devoid of any intuition. And so the formula is R, right? 1 over Q, and Q stands for quarterly, so there's 4 quarters, so this would be 4. And then it's multiplied by 1 minus the discount rate, the last discount rate for the whole T period, for the whole, in this case, 4 quarters. That discount rate, if you recall, for the whole end periods, so you think of this 1, 2, 3, 4. 4 is end periods, it's the 0.9524, as I'll show you in a second, divided by the sum of these discount rates. The sum of these discount rates, and the sum of the discount rates is denoted as, you know, the sum of these discount bonds, so to speak. Okay, and then that is the formula for calculating R. Now, like I said, this has absolutely no intuition, but it's the result that boils down from setting the present value of the cash flows, so that they determining a rate, the interest rate that sets the present value of the cash flows equal to 0 on a swap. Because it's really one equation with one unknown. And what's unknown? R. And when you solve for that, you end up getting 0.049%. Okay. Let's see. Okay, so now what we want to do is we want to get into swap valuation, valuing swaps. I alluded to it a few minutes ago. And keep in mind that swap valuation is not the same as swap pricing. So I'll say it again. Pricing the swap is what we just did, determining the swap's fixed rate, capital R, 4.9%. Valuing, it means we're putting it in dollars. What is the dollar amount of the swap? Well, we know initially the value is 0. But after that, rates change, and the value may be positive or negative. So why do we want to know the value? Well, there's several reasons that we want to know the value over the life of the swap. One is we may want to unwind the swap at some point in time. So think about it. You enter into a swap, and you negotiate it in. Typically, that's the way swaps are done. Swaps are typically negotiated. There are some that trade on exchanges now, and that's developing as we speak. But we may want to unwind and negotiate ourselves out of a swap at some point, especially if you could enter into a 10-year swap, and so you may want to get out of it. How much is it going to cost you to get out of it? Or maybe you'll gain to get out of it. Okay? The other reason you want to know what the value of a swap is, FASB, Financial Accounting Standards, will require you to mark to market the swap. And so you're going to need to calculate the gain or loss on it so you can put it on your balance sheet. Another reason you might want to know what a swap value is that, if you have a positive value on your swap and it gets very large, there's credit risk associated with that. So you have a large receivable from a counterparty, and since these are negotiated over-the-counter instruments, you may not get the money that you expect to get because for some reason the counterparty has a financial problem. And so you need to be aware of that potential, and swaps price in, to some degree, price in that credit risk. Okay, so we have several reasons on why we want to value swaps. And so now what we want to do is let's actually value an existing interest rate swap. So we're going to value the existing swap, and what we're going to do is we're going to fast forward 90 days. And so we just went through and did all these calculations of forward rates and spot rates at the time to price the swap initially. But now what's going to happen is let's pretend we're at the 90-day mark. Okay, and so now we're here at this mark, and so 90 days have passed. All sorts of things have happened in the bond market, so interest rates have changed since. Okay, so now what I want to do is show you where the interest rates are, the new spot rates, because we got a whole new set of spot rates that cover this time period, and a spot rate that covers this time period, and a spot rate that covers this time period. New spot rates, which means we have new forward rates that we have, and from those spot rates we have these new forwards, and we also have new discount prices for those $1 discount bonds in order to discount the cash flows back. And we're going to discount the cash flows back to this point in time because we fast forward to 90 days ahead. So let me show you the table for those spot rates. Okay, so we just assume we have new 90. So we're at the 90-day mark. We have 180 and 270 to go. There's only 270 days left in this swap. Here's the new Libor spot rates. And so it's 350, 375, and then 4%. The new forwards, and you can calculate these on your own, but right away, remember, there's no calculation for the first. The first spot is the same. The first forward is the same as the spot, 350, 350. And then what we can do is we can calculate, I'll show you how to calculate the new discount bond prices. That'll fall out of the calculations. Okay, so now this will be interesting because then we'll see, we're going to get down to the nitty gritty of calculating swap values. Okay, so let me switch over to another piece of paper here. Okay. So we have here, remember, receive floating. Okay, let's calculate the receive floating end of things. And we need we'll calculate in a second the pay fixed and see how they net out. So we have $10 million in notional value. And remember, the first spot here is 3.5, which is actually, I should say, the first forward is 3.5%. We're going to use these numbers here for the top part of the pricing, and then we're going to use the spot rates for the discounting because that's what the spot rates are used for, these discount rates. So let's calculate the receive floating side. Okay, and so the we're receiving floating, and the notional value is $10 million. We'll chop off the zeros, and what we're going to get is we're going to get 3.5%. That's what materialized, adjusted for a quarterly basis. And so that's our payment that we're going to get on the floating side. But we need to discount that by 1 plus 0.035 times 90 over 360. Roughly a little less than 1%. And so when we discount that by a little less than 1%, this factor right here, 1 over this factor, is 0.9913. And that is our first discount bond price, 0.9913. So if you invest 99 cents now for 1/4 of a period at 3.5%, you'll end up with $1. So that's how you interpret it. So this is the present, this whole thing here, this whole calculation is the present value of the first floating payment. And then we're going to have another floating payment that we expect to be this. and we need to discount it by the spot rate, and we need to discount that spot rate by 180 days. So this is a period that covers 90 days, but we have to discount it 180 days. So basically, we're calculating it here. We need to discount this period's cash flow this quarter. We need to discount all the way back 180 days, and that's what's going on here. And then we have one more payment, 10 million times 0.0442. Again, that is the forward rate, the last forward rate for 90 days. And then we need to discount that by the spot rate, which is 4% for 270 days. Okay, that is the received floating. Now we have to do the calculations for pay fixed. And the pay fixed is 10 million. The swap fixed rate that was given at 4.9%, that swap fixed rate doesn't change. Even though all the other rates here are changing, the swap fixed rate is the swap fixed rate. And that stays the same, but we have to discount it. Again, using the spot rate. And then we have to calculate the next fixed rate. Discount it. And then the next spot, or the next forward, or this next fixed rate here. Okay. And so what we need to do is net. Remember, these cash flows all net out. And so when you net everything out, what you end up with is you end up with a value of the swap today is equal to minus 69,216. Okay? So now we have a swap liability, right? Because it's a negative value. Things went against us. And boy, we need to ask yourself, why did that happen? Well, we're paying fixed at 4.9%. Right? And we thought rates would go up, right? But rates actually fell, right? So rates fell, so we're receiving a smaller amount, right? But we ended up locking in paying this high amount, okay? We thought this was going to be low, but it turned out to be high. Things went against us, and so the value of the swap is down $69,000. And so the detailed calculations are in the notes. And it would be a good experience for you to try to do those calculations. I tried to articulate that as carefully as possible in those notes to show you the details. But that's what so there we have it. We have plain vanilla interest rate swaps. Now, one of the things I need to let you know, and you kind of can realize this, is when it comes to a quiz or a test, there's no way you can do all these calculations on a test. You may be asked to do one particular calculation, like, what is the discount rate for this bond, for this swap at this point, or what is the next cash flow for this swap. But to compute the swap fixed rate, using all the math that I just did, or to calculate a value of a swap, even just a 4-period swap, there's a lot of calculations. So keep in mind, I'm not going to bog you down with calculation after calculation, but I can get at the heart of the material by asking you to calculate one specific number, and that's probably the best way. And it's usually the way if you probably never took other derivatives courses or high-level finance courses where there's a lot of calculations, but that's usually how it works. They ask you to calculate one specific number, give you the information. So the number of calculations are reduced significantly, but you still need to understand the concepts to get to the right answer. So now's a good time to cover interest rate swap quotes. Interest rate swap quotes. How do dealers price swaps? And I'll give you an example, and I have it in the notes there. If we have a 3-year swap, and the interest rate on a T note that has a 3-year, so this is a treasury note yield here, and this is the maturity to a swap, and the yield, the treasury note yield is 2.8%. You could have a bid price for a swap in terms of basis points, and it could be 15 basis points. And so you could also, and so keep in mind, you could also have an asking price, because swaps there's dealers on these swaps. There's a bid price and an asking price, and in basis points you could have, oops, let me make that a 19. You could have a 27-point ask. So you see the spread in terms of the swap fixed rate here, the spread of 8 basis points in total. And then you have what's called the swap's fixed rate, capital R, would be between 2.27 and 2.35. And so the swap's fixed rate can be priced as a function of an underlying treasury yield plus a number of basis points for the bid side and a number of basis points on the ask side, because that's what the dealer wants to sell it for. And so your swap fixed rate would be labeled, would be quoted as 2.27 for what the dealer will pay, and what the dealer expects to receive asking is 2.35%. This postscript is meant to give you an update on what's going on in the swap market. In brief, it's kind of in turmoil at this point in mid-2020. It looks like Libor, that we've been working with all throughout this chapter, will be removed and replaced by SOFR, which is the Secure Overnight Funding Rate. Let me explain first by giving you some background on the situation. In the Great Recession, over 10 years ago, there was a revelation in the market that Libor reflected and incorporated some credit risk. And we've been using Libor as though it was a risk-free rate. And remember what Libor is. It's an interest rate that's associated with euro deposit rates in banks. Well, when the Great Recession hit and the banks almost went under, the interest rate associated with Libor deposits skyrocketed because nobody wanted to deposit their money in a bank that might possibly go bankrupt. So they demanded a high interest rate, which meant that Libor versus, say, Treasury security rates, which are risk-free, diverged significantly. In other words, Libor went significantly above the risk-free rate. And that caused some people to question, well, why should we be discounting with Libor when it's really not a risk-free rate? The other thing that happened around that time period was there was the Libor Scandal. And the Libor Scandal worked like this. For years, Libor was collected by telephone. So there was an individual that would make phone calls to the top banks in London and ask them, what's your average rate for 1 month and 3 month and 6 month euro deposits? And the bank would provide the number and somebody would calculate an average, and that's what would be published for around the world for trillions of dollars of notional value of swaps and other credit instruments, interest rate instruments. Subsequently, it was automated, obviously. Problem was it was subject to manipulation. The banks that were giving the quotes could manipulate the numbers, and the person doing the averaging could manipulate the numbers. And that's exactly what was happening. The quotes that were being received for averaging were shaded because of the fact that those banks had positions, huge positions, in interest rate swaps and futures contracts and other derivatives that were directional, that ultimately totaled out to be directional bets on where interest rates were going, up or down. And so the quotes were shaded to try to improve the individual bank's position in those derivatives markets, in order to profit. So basically we had a tainted Libor number, and that all came out in court, but people realized how susceptible Libor was to manipulation. There was trillions and trillions of dollars in notional value tied up and connected with Libor that was being manipulated. So with that happening, the regulators and the industry look closely at a replacement rate. And that's where the secure overnight funding rate came in. It's produced by the Federal Reserve, so not likely to be manipulated. It's an interest rate based on U.S. Treasury collateralized overnight repos. Okay? It's the U.S. Treasury collateralized overnight repo market. And so it's considered risk-free because it's overnight. There's no real term structure component to that. It's overnight, very short term, and it's collateralized by U.S. Treasury securities, so people consider it risk-free. So that leaves us with an issue now. What's most likely to happen coming forward in the swap world is that there's going to be dual curves. So far, we may not realize it, or I haven't really brought it up, is that we've been using a single curve to figure the numerator and the denominator of the swap cash flows. So the numerator, the floating rate, was based on Libor. And then the discounting factor that we were using all along was based on Libor, the same yield curve. And so now what's likely to happen is we'll have a SOFR floating rate, which is the numerator, the top part of those fractions, and we're likely to have a discount rate, another interest rate to use for discounting. There's no reason why it has to be the same yield curve, so to speak. You could have one floating rate and discounted with another rate. Or it possibly could be SOFR to SOFR, one on top of the other, but we don't know how that's going to work. Now, one of the issues, as I alluded to a second ago, was SOFR is just an overnight rate. There's no term structure to it. We need at least 1 month and 3 month maturities out there. So your dollar deposits made sense. You're depositing your money for a month. What's the interest rate associated with that? Depositing your money for 3 months. What's the interest rate? That's pretty straightforward. But with SOFR, there's no dimension. That time dimension is missing because it's an overnight lending rate. So therefore, what had to be developed and is developing right now is a 1 and 3 month futures market for SOFR. And that's been developed by the CME, the Chicago Mercantile Exchange. So those futures markets, those are markets that are going to have that interest rate as a price, a futures price. So the swap market will work off of the futures market, the interest rates that derive from the futures market. So that's an update on where things are going. I have a feeling that the reason for the textbooks being delayed in the updating in the latest editions, probably because this is wreaking turmoil and the dust hasn't settled yet in the market. So what exactly is the market going to settle on as a convention? We don't know yet. And so that's probably the cause of the delay of a new addition to our textbooks in derivatives.